If money is a cause of concern in your life, then you are not alone. In USA, one study showed that 77% of respondents felt anxiety about their finances. The good news is you do not need a higher paying job or an inheritance from your family to improve your financial situation. By following simple steps and taking advantage of available resources, anyone can achieve long-term financial goals. Here are some tips and techniques that will help you to build your confidence to achieve your financial goals. 1. Track your expenses to improve your finances. Tracking expenses is the first step to better money management. If you know where your most money goes, it can help you avoid overspending and stay within your budget. How do you keep track of your expenses? It's easy. You can record your expenditure digitally using various apps available online. If you do not want to put your data online, you may also write down the expenses manually in a notebook. Once you have the data, you can categorize your expenses and track how much you are spending on non-essential things like entertainment, restaurants, and even your daily coffee. If you know the expense trends, you may develop a strategy for improvement. 2. Make a realistic monthly budget. There is no point in setting a stick budget based on drastic changes, such as never eating out, when you regularly order takeout 3 to 4 times a week. Make a budget that fits your lifestyle and spending habits. However, creating and sticking to a budget will assist you in making better financial decisions and managing your money. There are various ways to make a personal budget. You should choose the one that you think will help you succeed the most. Zero-based method. Put all your monthly income into expenses, savings, investment goals, or debt repayment. No money will remain for the extra expense. This can help you to stick to your budget. 50-30-20 rules. Spend 50% of your salary on your essentials needs, such as rent, groceries, utilities, car payments, and other regular monthly costs. Spend 30% of your income on wants, which means for non-essential expenses such as eating out, shopping, vacations, and signing up for any memberships or subscriptions. The final 20% of your income, put into savings and investments. 80-20 rules. Put 20% of your income in savings and investment and spend the remaining 80% as you like. Envelope method. Mark each envelope with an expense, such as groceries, rent, savings, or vacation, and fill it with cash up to your monthly budget. Or you can use an app to set virtual spending limits and stick to them. It is important to understand, no need to follow every method. Know yourself and your habits and choose something that works for you. 3. Build saving and investing habits as early as possible. You must start saving as early as possible. Let's understand this with an example. Consider Mr. A, who starts saving at the age of 20, $500 per month, till the age of 60. Mr. A saves $6,000 per year. Let's compare this with Mr. B, who starts saving at the age of 35, $1,000 per month, till the age of 60 like Mr. A. He saves $12,000 per year. The total amount saved over the years by Mr. A is $240,000, and Mr. B, $300,000, $60,000 more than Mr. A. Let's assume for both, the expected annual rate of return is 5%. Value of savings at the age of 60, Mr. A will receive $724,799, and Mr. B will receive $572,725. So, You can see how saving earlier has benefited Mr. A extra $152,073 more than Mr. B. Even though Mr. B saved $60,000 more. Simply, the earlier you start saving, the more interest your savings will get over time. With the power of compounding, you will earn interest not only on your savings but also on the returns earned every year. Therefore, saving early helps to generate more money with the power of compounding over time. Similarly, the earlier you start investing, the more interest you gain from compounding in your investments. Even if you have limited money, you can start your investment by starting a systematic investment plan, SIP, in mutual funds or index funds. Regular investing will also help you to build discipline in your spending habits. 4. Save for emergencies. As a part of better money management, it is recommended to save for unexpected events, such as losing a job, getting sick, having a broken car, or needing major home repairs. As a preparation, one of your goals may be to increase your savings. If so, you may consider the following tips to help with unexpected expenses. Remember, interest rates can vary. So, it could be a good idea to shop around. If you discover a savings account with a higher interest rate, consider opening an account, and the extra money can add up over time. Put extra income into your account. If you get a tax refund or a bonus, you should save it in your bank account. The extra money will help your savings grow. Buy what you need rather than what you want. This way you may grow your savings. Set up automatic savings. Set up an automatic monthly transfer of a specified amount from your regular payroll account to your savings account without the temptation to spend extra. 5. Create your retirement fund. A survey found that Americans are concerned about their financial future, including retirement. 68% of respondents said they are concerned that they won't have enough money for retirement. You will no longer receive a salary or regular income when you retire, but your expenses will remain the same. You need financial support to maintain your expenses and live your post-retirement years, which is why you should start planning your retirement now. Start saving and investing to build your retirement fund in a balanced and safe option like a balanced mutual fund or a large cap mutual fund to stay independent in your future. You can also invest in public provident fund and national pension plan. The goal is to maintain and grow your wealth at a normal pace. 6. Pay your bills on time every month and maintain good credit habits. Paying your bills on time is a simple method to manage your money effectively, and it has several advantages. It helps you prioritize important expenses and prevents late fees. A solid on-time payment history can also boost your credit score and lower your interest rates. Paying off debt can also help you better manage your finances and reduce money anxiety. The Consumer Financial Protection Bureau suggested the following 2 methods for getting out of debt. Snowball method. This method focuses on paying out the smallest balances first. You're still making minimum payments on all of your loans. At the same time, you use excess money to pay off your smaller balance. Then use the released funds to pay the next smaller balance, and so on. This could mean that loans with higher interest rates will take longer to repay. And that could cost you more in the long run. Debt avalanche method. In this method, also known as the highest interest rate method, you list your loans in order of highest to lowest interest rate. You pay off the loan with the highest interest rate first. Once it is paid off, you may use the excess cash to pay down the next loan on your list. You also keep making minimum payments for all of your loans. 7. Plan for big purchases. When making big purchases, like a house or a new car, a loan might be useful. But for other big purchases, like big screen TV or washing machine, cash is the safest and cheapest purchase option. By paying cash, you can avoid accruing interest and building a debt that will take time to pay off. If you are a married person, it is important to have discussions with your partner to make sure you are both on the same page regarding your financial goals. Remember, you absolutely can effectively manage your finances. It will only take a little time and effort to bring your finances under control. And now you know more about strategies for managing your money, setting your monthly budget, paying debt on time, and building an emergency fund. If you keep working on them, they will eventually become your habits. And this will improve your financial life and protect you from any financial crisis.